Welcome back, everybody, to another episode of Capital Clarity. We're back. It's been a while, but we're back. We've been busy. We've been having some fun along the way. It is Wednesday, July 15th at 3:33 p.m. It has been a minute. If I can, I would like to just share some of the things that we've been up to. I'll share a little race we did. I think we talked about this on the last episode. Can you see that, Rick?
Yeah, I got it.
All right. It is this is the triathlon we're running. It's the sprint tri that we ran in Avalon. We all did pretty well. It was a tough one this year. But we swam against the current, which we don't usually do in the ocean.
Yeah, why'd they have us swim against the current?
Frustrating. Very frustrating.
You could see it when the elites went in the water that they had them swimming against the current. And the elites don't care. They're elite. But guys like me, I care. That was a brutal swim.
From left to right there, that's Connor. That's me in the middle waving, and then that's Rick on the right there.
Yeah, so, I'm not smiling.
For those of you watching and not listening.
Yeah, I'm not smiling or waving like you and Connor. I am going, oh my gosh, how long do I have to ride this bike for?
And then we were in Colorado on a Raymond James trip, actually, a little conference out in Colorado, which was fun. We found some time to hike. Took a picture of a giant cliff there that we hiked up to, which was terrifying because I hate heights. But I do love hiking, and that's me on the left there for those of you watching.
Yeah, that was great. We hiked Flagstaff Mountain and
in Boulder, Colorado.
In Boulder, and that was a lot of fun. I got another pick for this when you're done with yours.
Yeah, well, I just want to say I always pictured Colorado as being colder than Pennsylvania. No, it was hotter. It was hotter.
It was smoking hot.
Somehow hotter. My skin was roasting. And then here, can you see this?
Yes.
We got. I saw an eagle and a bear out there. One of them is real, the other's not. See which one you can tell is real.
That's a big bear. That thing's huge.
Yeah. And actually, the eagle doesn't look real for those of you watching, but I swear it is real.
The eagle's real. Yeah.
The bear's fictional. That's not. For the main reason being that I'd be sprinting away from it if a bear that big, if any bear was next to me. But, yeah. What do you have? I want to see the pictures you have.
That's funny. Or I'll share just a couple. There you go. There's the three of us.
That was a great hike. It was what was that? Gross Reservoir, I think is what it was called.
Yeah, Gross Reservoir Point, I think. It was a good hike. And then here's your video. Took at the top of Flagstaff Mountain.
Oh, you included my little video.
Pretty cool, right?
Oh wait, it's buffering. I don't know if that's gonna play through.
If that didn't play through, that's all right. No worries.
Well, I promise you, ladies and gentlemen, it is a cool video that I took. But been a fun end of June and early July. We've been traveling a lot, working a lot. It's been busy but good.
And don't forget, in Boulder, we went to West End Barbecue. If you guys go to Boulder, go to West End Barbecue. That place is awesome.
Little plug for them. It's that place is killer. I mean, growing up in the Philly area my whole life, I actually ordered their cheesesteak just because it was a smoked prime rib cheesesteak. And I thought, okay, I've never had something like this. And and the waitress was so curious to hear my opinion on it because she knew we were from Philly. Yeah. Or the Philly area. And it did not disappoint. It was really good.
Yeah, that's cool.
Yeah.
That's a fun time.
All right, well, back to business here. I'd like to kick it off with something kind of fun. Just because, well, everything we do is fun, obviously. But just because we had the All-Star Game, the Home Run Derby, let's go with some baseball real fast. Can you see this?
You just stole my next slide. Nice work. I love it, though.
So this is from Card Ladder and Bloomberg for those of you listening. Out of the park, the growth in baseball cards value has exceeded the S&P 500 over the past decade. So the baseball card index value is worth more than the S&P 500 if you put money into both 10 years ago.
So over 10 years, the baseball card index has gone up sixfold, 600%. And the S&P's done great over that time, but the baseball card index has killed it. I did not. I mean, I know they're up. I didn't know to this degree until I saw this chart.
I have a friend who really likes trading baseball cards. And if he's watching this podcast right now, which I know he probably will be, he's probably smiling at this. So shout out to him.
Yeah, that is so. As a longtime baseball card collector, I mean, I haven't collected recent cards in years, but when I was a kid, I did a ton of it, and I still got them all. And right during the COVID period, well, actually, is it on this chart? Yeah, look, you can see the spike during the COVID period. They really skyrocketed in 2020 and 2021, and I started, trying to value the cards I had, and I quickly realized it's really fickle. You got to get them graded, and they grade them really tough. To have a mint card, you think, oh, this thing's mint. It's not, and that's what happened to me. So can I share my screen? So
No,
here,
not allowed.
this is an image of the 1980 Ricky Henderson rookie card from Topps. And I'm sharing the wrong one. Hold on a second. Anyway, the 1980 rookie card from Topps, which tends to be one of the most highly valued cards. Now there are others, Mickey Mantle rookie, Honus Wagner, all that stuff. But this is a modern day highly valued card, and this is just a screenshot I took from
125 grand for one baseball card for those of you listening.
Yeah, I mean, it's just a screenshot from a Google search, 1980 Topps Ricky Henderson rookie card, and there's a $125,000 card on eBay. But the one next to it for the same card, obviously the condition's not the same, is $75,000. Then there's one for $200 and one for $138. I mean, this is the lesson I learned the hard way during COVID when I tried to value my baseball cards. Hey, they're all up in value. What are my cards worth now? I haven't pulled them out in years. They're covered in dust. And then you go and you look, you go, I guess I don't have the $125,000 Ricky Henderson. Because I got 3 of those Ricky Hendersons. They're probably worth $50 altogether.
Yeah. Maybe we become baseball card brokers. I'm kidding. I'm just kidding.
I got a finance hack. So it's that time of year where I'm starting to get requests to make tuition payments out of clients' 529 college savings plans. So everybody's eyeing up that bill that came in the mail or is coming in the mail for the fall tuition. And so what'll happen is a lot of very kind grandparents might say, well, I'm going to help Johnny or Sally with her college costs, so I'm just going to write him or her a check for $10,000 or $5,000, whatever it is. I'm just going to write them a check and say, here, use this for school. That can hurt your grandchild when you do that. It's generous, but you could shrink their financial aid because money in a student's name gets counted the hardest against student aid. You can still help them the way you wanted to help them, but don't write them the check. Instead, consider paying the school directly. Let them know, hey, I'm paying for part of your tuition this year. I just wrote a check, and it's going straight to your college. That does not count one penny against the financial aid formulas. So if you're going to help your kids or grandkids with college, don't put the money in their name. Pay directly to the school.
Yeah, couldn't agree more. It's great advice.
Yeah.
Yep. All right, I added a little funny image to this because I feel like I've been really hammering on this lately. It's the Will Smith going, with his arms out for those of you listening, just to basically prove the point that, look, what I've been saying is real. Everyone keeps saying, hey, this is just like the dot-com bubble, this AI bubble we're having or supposedly having, where, the prices of these stocks are getting so crazy and companies aren't making the money to back it up. Well, actually, if you look at this piece from Riverfront data, this shows how, again, for those of you listening, it's showing the price to earnings ratio of the 1999 tech bubble versus 2026 tech companies right now. And then it's also showing the profit margins of the 1999 tech bubble companies versus the 2026 tech companies. And basically what it's showing is that the prices of the 1999 tech bubble companies were so high and they far exceeded the profits they were making, the money they were taking in. Whereas in 2026, so far, these tech companies, their prices are really not exceeding the profits that they're taking in. They're pretty on par. The price is reflecting the money that the company is making on average.
Yeah, I mean, I was a trader on the floors of the exchanges in 1999 and through the late 90s when that tech bubble blew up to a bubble level and then burst. And now everybody, wants to call the next one. And it's very popular right now to say, well, this is the next one. And, we had a client earlier in a meeting say, yeah, eventually the bubble's going to burst. Well, we're just not. I mean, you look at these numbers. We're not there yet. Could we be there in a year, 5 years, 10 years? Sure. Humans do dumb
Absolutely.
stuff.
I'm not saying we can't get there. It's just to say we're there now is a little premature.
No, because what you're showing here is a great chart. I didn't see this one. It's basically saying, listen, tech stocks are twice as inexpensive as they were in the actual tech bubble in the late 90s. Like they're very inexpensive comparatively. And their earnings today are significantly higher than those of the 1999 period of the tech stocks. So this is earnings don't lie. Price to earnings doesn't lie because earnings is the denominator in that equation. And it's really hard to argue that we're there in a bubble stage. We could get there. Just this doesn't scream it at all. Yeah, that's a good one. All right, so here, good timing. So bubble. So this is an image of the stock market in South Korea. And it's good, for those of you who are listening, it goes back to right around 2021, 2022. And it basically was sideways, a little bit down, flat for a bunch of years. And then in the summer or so of last year, it just took off. Hockey stick straight up and to the right, went up about 450% over the course of a year and a quarter. And why? Well, this next one shows you. Well, this is what makes up the South Korean stock market. The two single largest holdings make up about half of the entire market. Could you imagine if the S&P 500 had 500 stocks in it, but the top two stocks made up half of the entire market? Well, that's what they have in South Korea. SK Hynix, which is a semiconductor memory chip company, and Samsung Electronics, which everybody knows, another tech company. Those two stocks make up half, and it happens to be they're in spaces that have just, whether it's South Korea or not, have been on fire this year. I mean, everybody needs memory chips, everybody needs semiconductors, and that's what these companies do. It makes sense that they all went up. The only thing is that, look at this. So what happens? Humans get FOMO. They say, well, look how South Korean investors say, well, look, it's going up so much. It's already going up so much. It's just going to keep going. Trees do grow to the sky. So what'd they do? A whole bunch of people borrowed money on margin to buy more stocks. So I only have $100,000, let's use dollars, to invest in the South Korean stock market. I'll borrow another $50,000 or $30,000 or whatever from my brokerage firm so I can buy an extra $30,000 or $50,000 worth of stocks. Heck, it just keeps going up. Why would that be a bad idea? Well, this is why. The South Korean stock market still is up a ton over the last year and a quarter, but recently fell 20 or 30%. And what happened? It says right here, leverage play in South Korea blowing up. 350,000 accounts liquidated by brokers due to margin calls. So basically, they borrowed money, and then the stocks that they bought with that money went down, and the brokerage company said, you owe us your money back, we're margin calling you, and that makes them liquidate all their positions at lower prices. So I did the math on number of investors in South Korea and so on. Basically, 1 in 30, which is an amazing number, 1 in 30 South Korean stock market investors got margin called. 1 in 30. That is ridiculous. South Korean stock investors basically turned leverage into a contact sport, and now they're just getting liquidated. It's brutal.
It's like their own little mini great financial crisis almost.
It is. It's self-created. And the thing is, it's not South Koreans. It's not them. It's humans. Humans do this kind of dumb stuff when something seems like it can never go down. So it's just another example of a different crop of humans doing the same thing that all of us are tempted to do at times, which is, well, this can't be beat. I'm just going to go all in and then some.
It's FOMO, and then it's also recency bias, where you think we as humans have a tough time thinking past a week ago or a week in the future. It's tough for us to think long term, but that's so important in the investing world.
Yep.
So I want to talk about this is from Bloomberg. I want to talk about buybacks. So over the last, really since COVID, you've had a lot of these big tech companies, a lot of them in the Mag 7, buying back shares of their stock. They use money they make to buy back their own shares, make their shares more scarce. And a lot of them have been doing this. Here's a chart showing Google, Meta, which is Facebook, Microsoft, and Amazon doing it. I'm surprised Apple's not on this chart because they did it a lot. But it's showing as of late, these buybacks are disappearing. The total value of shares repurchased by biggest AI spenders is going down. And I can't help but think that this is them turning their spending from buying back their own shares towards AI build out. They're trying to put CapEx, capital expenditure, into AI.
That's exactly right. They for years these companies sat around and said, "We're making so much money, we don't know what to do with it." And what they would do is maybe buy another company, a smaller company, hire some people, pour more money into research and development. But even that wasn't enough compared to how much free cash flow they had. And so they looked around. And they said, "Well, we could pay a dividend, bigger dividend, or a dividend." And that's taxable in a negative way. So they said, "Well, let's do a dividend, but without the tax, which is basically share buybacks." And now that they have that free cash flow pouring towards AI build out, artificial intelligence, they don't really have the money to buy back their shares. And it's interesting because these are four of the Mag 7 stocks, and the Mag 7 stocks have lagged the overall stock market this year. And this is probably one of the big fat reasons why. I mean, when there are less buyers, the price doesn't go up as much. And when your own company's not buying back shares like they were before, yeah, there are less buyers.
Yeah. Yeah.
That's a great
Really
chart.
still surprised that Apple's not on this. I think
Yeah, I don't know why they
missed the
decided.
boat on that
Well,
data point.
I wonder if the bigger part of that article might have been talking about the AI spending, and Apple hasn't done as much AI spending as the other companies, so maybe it blew apart their argument a little bit, you know?
Yeah, but look at all the buybacks they had.
So check this out. So I might get it a little wrong, but I think it was yesterday. The House of Representatives voted on whether or not to make daylight savings time permanent. So basically, we wouldn't change the clocks anymore. And in a way, on the surface, to me, it sounds like, yeah, good. That's a hassle twice a year anyway. So let's just do that. But look at this image of the United States, and it's showing you the latest winter sunrise. So you wake up in the winter on the day when the sun, based on us not changing the clocks, the sun comes up the latest in the morning. And you'll see that right in the Midwest there, you'll see a 9 a.m. I mean, 9 a.m. is when the sun breaks the horizon on the darkest morning of the winter if they don't change the clocks. If you think about it, Keith, that's like 1 or 2 class periods into school. So the kids have been in school for 1 or 2 periods already. Forget about riding the bus and getting to school in the dark. They've already been in school for 1 or 2 periods before the sun even breaks the horizon. It's really like 2 hours into most blue collar jobs. So you're working a construction site or whatever you're doing, it's pitch black for at least the first 2 hours of your day.
This would pretty much guarantee everybody in the U.S. is driving to work in the morning in the pitch black.
Yeah, it's interesting. I mean, I never thought about it from this angle. Now the counter argument is, well, you get a little extra sun at the end of the day. You know, 5, 6 o'clock, you got more sun. It's like, is that really? Is that the best trade-off? I don't know. But when I saw this image, I thought this is crazy. I can't imagine if I had a kid in grade school and they had to spend the first 2 periods in pitch black. And I mean, it's just not. I don't know. Kids are tough enough to keep in their seats and keep their attention. I got to imagine that's going to make it harder.
Yeah.
Yeah, we'll see if it sticks.
Mixed emotions on this one. Mixed emotions on this one.
I could tell you want it.
I don't know. I really don't know. I don't mind the hassle. I just I don't mind the hassle. Listen, I hate winter anyway. So
yeah, I get up so early that
why not make it a little bit worse anyway? I don't care. Yeah. Winter's winter. Winter is never fun for anybody. So
I don't think I've woken up after sunrise in years, and I know that's not good in a certain way, but. So to me, it's like whatever. Yeah. But for a lot of people, it's going to impact them.
You know, seasonal emotionality or whatever you want to call it at the end of winter, where they're like, "Oh, so much winter." I get it right at the beginning. I get it like right after New Year's Day. I'm like, "Oh,
really?
We got to go through 3 months of this miserable, dark, boring time of the year."
It'll be interesting if they pass it.
Yeah, would be interesting. Keep an eye on that. Again, we don't get political on this show. Never intend to. Just covering current events here as it relates to real estate and shifting to real estate. So New York, they're implementing rent controls, it seems like. Am I correct?
Yeah.
This is a piece of data from Street Easy. And for those of you listening, it says New York City's median one-bedroom rent just hit a record $4,000, up 54% over the last decade. Rent control helps the lucky few who already have an apartment. Everyone else competes for a shrinking pool of housing at even higher prices. Yeah, I mean, if just economically speaking, rent controls don't require landlords to keep maintaining, to keep operating apartments or rental homes in the city. They can leave, they can move, and that shrinks the pool of housing available, and it just will make it more expensive. Those rent controls will have to inch higher every year, even though they'll be quote unquote controlled. It will inch higher, and there will be less to choose from, and what you can choose from won't be very flashy.
Yep. Yeah. Uh, They're trying to control one slice of the money pie, but the money sloshes all over. And so all that happens when you control one piece is the other piece goes up in price. It it's kind of crazy to me, but it sounds good on the surface. But when you understand basic economics, you say, well, this will have collateral damage elsewhere.
Well,
And
sorry, go ahead.
so, real quick, I saw a year ago, New York City passed a law that said so when somebody rents an apartment, there is an 8.5% broker fee. So you use a broker to find your apartment, and you would have paid an 8.5% broker fee. They passed a law that said the landlords now have to pay that 8.5% broker fee, which renters go, yeah, I don't have to pay that anymore. The landlord has to pay it. Well, that was a year ago. They just announced a report that showed how much rent has gone up in the last year. Guess what? 8.5%. Why? Because the brokers just pass it on in higher rents. I
Yeah.
mean, the landlord just passes it off in higher rents. They're not just going to eat that. They're going
And
to recoup it. Money moves around. It doesn't just stay in one spot.
when it comes down to it, landlords are business owners. They own these buildings, these properties, so they can collect income from tenants.
Yeah.
And uh, if let's say, okay, let's say rent controls in New York weren't a thing, and like they have been for a while, and let's say a landlord is, let's call it price gouging, and he's really driving up the he or she they're really driving up the prices of their property, to rent at their property. Well, if other landlords see that, they're going to go, why would I do what they're doing and raise prices? I'm going to keep my prices the same or lower them so I can attract more tenants. And they're all going to come to my building, and they're going to be clamoring to pay me rent. I'm not going to go to them because they charge too much in rent. It's the free open market. Just let the market sort itself out. Don't control it. And these landlords are not driving up the price to $4,000 because they're trying to get incredibly wealthy. They're doing it to keep their heads above water, because anything
Yeah.
less than that, they're not. It's pointless to even own one of these properties.
Yeah. I mean, so I'm sure, just to counter, there's a lot of scumbag landlords, there's
Oh,
slumlords and all
absolutely.
that, right? But the thing is, if I'm a landlord up there and I own a bunch of properties and I say I'm going to change my rent to 6,000 a month, well, it might work. I might get some people who still rent, but most people aren't going to. They're going to go elsewhere. So I'm going to have a lot of vacancies. That's the free market at work. Is going to punish people who generally do the wrong thing. Whereas if the government intervenes, it could be a temporary help, but it's a long-term pain. It
It's a
doesn't.
band aid. Yeah.
It is. It just doesn't. It's a band-aid that later creates a much worse disease.
Yep.
It's hard.
Yeah. That's enough
So
of that.
Vanguard has this cool tool on their website that it's been there for a while. That basically kind of shows what if you made two different decisions based during a market decline. And I just thought I'd show one of them. So this is a 2020 chart from the year 2020, COVID, obviously the COVID-19 outbreak. And it shows two choices. The stock market did okay at the beginning of the year and then got crushed from February to March. And if you decided that you were going to take the $100,000 initial investment that you put in there and exit to cash in late March 2020, you're like, listen, this COVID is bad. It's all over the news. We're never coming out of it. It's a real problem. And you say, that's it. I'm just going to cash out. I know I've only got about $68,000, but it's better than seeing it go to zero because I think this COVID thing is going to destroy the economy forever. Well, if you did that and exited to cash, of course, you ended 2020 with about $68,000. If you said, okay, this is difficult, but I'm going to stay invested in the stock market, well, you ended the year at almost $121,000. So just a real good visualization of how emotions and panic selling, when things are scary, because they were scary, really can have long-term negative impacts financially. I mean, people basically panic sold. They felt very relieved all of a sudden. Oh, I'm so glad I did that. And then they just calmly basically watched about $50,000 walk away from them. And
Build a plan and
yeah.
stick with it. Listen, I'm in my 30s. I have at least two more decades until I can access, penalty free my retirement funds and my 401k and IRA. And I know that during those two decades or so, I am most likely going to get a 20% down cycle, maybe more, probably more than one as well. I'm going to have
Yep.
many days that are down 5%. But in the long term, it's going to be up and to the right. It's just
Yeah.
as long as I accept the long-term plan and stick with it, I'll be fine. And
Yeah.
it's the
Historically,
price
that's
of being
exactly
a
what's happened.
yeah, historically. Yeah, it's the
Yep.
price you pay for being a stock investor.
Yeah.
It's
And I bet you a lot of people who puked out their positions at, down at the low there in late March 2020 thought, it's all right, I'll just get back in later. And those are the famous last words of people who just never get back in later. Because if you look at this chart, right after the bottom, it just started running and didn't look back. What do? Do you go, okay, well, I'll get back in here? Your brain is screaming to you, well, I can't do it now. It's up. And it goes up more. Well, I really can't do it now. It's the get back in later crowd.
Well,
Nobody really pulls
to
them.
quote you, you always say, listen, if you sell, if you panic sell because of the news or because you're seeing a down cycle, it is not just a one step decision. It's two steps. It's knowing when to
Yep.
sell, which is the easy part because you just panic and hit sell, and then it's also the harder part, knowing when to get back in because you're inevitably not going to get back in at the very, very bottom. You're going to get back in somewhere
Exactly.
along the ride back up to the top, and you're going to miss all of that spread along the way.
Yep. That's exactly right. Yeah.
Yeah, I'm sticking on real estate just for one more second. I got this piece from Visual Capitalist. I thought this was fascinating. Um, Home price surges by state over the last 5 years. So this is just from 2021 to 2026, and it's showing and I'll read some off for those listening. It's showing a map of the U.S. and the percentage at which the home prices went up from the year 2021 to the year 2026. The highest is Maine, up 58%. So Maine's home prices are up 58% from 2021. Maine and Vermont, those two. A lot of the higher prices are in the Northeast, for example. A lot of them in New England. New Hampshire up 52%, Rhode Island up 50, Connecticut up 53, Jersey up 54%, Pennsylvania up 52%. Actually, if you look at the West Coast, those are the lower numbers.
They are.
So
Interesting.
California home prices are only up 24% over the last 5 years. Oregon 22, and Washington State 27%. The lowest is DC, up 1% over the last 5 years. Their home prices.
That's interesting. Really interesting.
Yeah.
Some of these don't make sense. Maine, Vermont. Is that because they were so low to start with? I
So
don't understand.
It's got arrows over Maine and Vermont saying, fueled by pandemic era buyers seeking a better quality of life, Maine and Vermont's price surges now lock many buyers out. So I guess people just wanted to really move there during COVID, which I get it. It's a very rustic, rural, peaceful area. But
Yeah.
I've been to both
So I
those
guess
states.
Louisiana was the lowest growth rate.
No, DC.
Looks like. Oh, DC. I'm sorry. Outside of DC is what I meant to say.
Yeah,
Yeah.
yeah,
I feel like DC's. Anyway, it's feels like it's not really a place.
yeah,
Like when you think of states.
yeah, yeah.
Interesting.
Yeah. That's all I had, everybody. I hope everyone's enjoying their summer. We will put out more content more frequently. We've just been busy having fun and busy working.
Yeah,
So.
it's summertime. Everybody, go outside and enjoy it.
What are you doing listening to us? Don't listen to us. Go. You know what?
Yeah.
Go out for a boat ride and play us on the boat, or when you're going for
Yeah.
a run or at a picnic. Yeah.
Or just binge watch us or listen to us in September or something.
You know what? Listen to us on your ride up to the Poconos or to the shore. That's
There
a
you
good
go.
time to listen to us. Yeah.
Yeah.
All right.
All right.
Thank. The Capital Clarity podcast is presented by FA's Keith Wagner, AA.MS Financial Advisor, and Rick Wagner, CFP, Senior Vice President, Wealth Management. This podcast is for informational purposes only and is not intended to be taken as financial advice. All opinions expressed are of the hosts and do not necessarily represent those of Raymond James. Opinions are as of this date and are subject to change without notice. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Prior to making an investment decision, please consult with your financial advisor about your individual situation. 2003 South Easton Road, Suite 100, Doylestown, Pennsylvania 18901, 267-742-3455, Raymond James and Associates Inc., member New York Stock Exchange SIPC. The S&P 500 is an unmanaged index of 500 widely held stocks that is generally considered representative of the U.S. stock market. The Dow Jones Industrial Average, DJIA, commonly known as the Dow, is an index representing 30 stocks of companies maintained and reviewed by the editors of the Wall Street Journal. Inclusion of these indices is for illustrative purposes only. Keep in mind that individuals cannot invest directly in any index, and index performance does not include transactions, costs, or other fees which will affect actual investment performance. Past performance does not guarantee future results. 529 plans come with fees and expenses, and there is a risk they may lose money or underperform. Most states offer their own 529 programs, which may provide benefits exclusively for their residents. Please consider whether the state plan offers any tax or other benefits. Tax implications can vary significantly from state to state.